I'm just going to if you can email that through to me, that'd be super, super helpful. The one thing I'm not seeing in here, which is going to be important, is so you've got some debt with the IRD and you're in catch-up mode there, but we want to be also preparing for the next, the next provisionals and so forth. And so what I'm not seeing in there, because it's still pretty tight, right, is actually putting aside money for taxes, for future taxes.
Yeah, so it's kind of like, I mean, essentially my take was, well, we've got to get this under control, because that's like risk.
Yeah.
And if we maintain that, then, it's actually like from here, then from April, it's like, okay, we need to start putting aside, because there's going to be tax, because we haven't put anything aside for this year. And, we do this, it'll end up being maybe 150K or something like that. I'll need to, anyway, so there's going to be tax that'll be due in next April. So we're going to have to kind of do a bit of catch up. Through, because this is, I was just going, well, just kind of have to get that there dealt to. And then here, there's almost like actually just banking some cash to have some buffer, and then start getting on top of the tax. And then this here is going to pretty much, the main part of it is, it's end of August, it runs out. And then, so that's like, $7 grand a month that can go elsewhere. So I get that. So this was more just me going from a
what happens in the next
immediate short term, like do I need to make bigger cuts or
immediate needs,
what have you. So that was
so I'll show you, because what we can do, and the way that we like to do Profit First is just set the percentages for a quarter, and then the next quarter readjust the percentages and so on and so forth. And so the way that you've laid this out with some of the things going on, that works perfectly well. So what we can have a look at, so let me share my screen and I'll show you what I've put together for you guys, which is definitely a little bit more, sort of complicated than but it's been a really good exercise to go through, to start to think about, well, how do you work with the e-wallets and so forth. And I talked to a couple of other Profit First professionals who are using e-wallets for their own business, and so everyone's doing it slightly different. So it was interesting, but not necessarily all that helpful. So what I thought, so the way that I've set it up now is, so here's sort of your master calculator, right? And we can talk about what those percentages are. Like, for this quarter up until March 31st, if that tax is like, 0% or 1%, that's cool while we're, getting through this crunch. But then we've got your AUD, sort of calculated there, your USD calculated there, your consulting company here, and what we can do in this one, actually, I was just thinking that as you guys were talking, let's put Alice's, take home in here as well. So then then you've got your costs in terms of the USD and the AUD, and so what's left over. So we'll need to figure out what those percentages look like, and then what's left over. So there you're paying in the local currency. You're not, exchanging money to sort of bring it back and then send it back over. But then what's left over from that, because they're all kind of, direct costs, right? So there's, and so what's left over is the real revenue that then you'll work out, okay, well, you'll plug in what today's exchange rate is so that you get that number in New Zealand dollars. and then that will all feed back into here, into this real revenue number rather. So you're not, so your concern about the Airwallex accounts, like, you know, you've got money coming into them and you've got money going out of them. What will be left over is that real revenue, and is there anything that can be moved over? And while in the long term, you can then start just leaving that money over there. In the short term, I would still suggest if there's anything left over every week in the Airwallex accounts, you just move it over, regardless of what the exchange rate's doing, because you need the cash.
Yeah. I mean, mostly it's the money. I mean, last month was a bit of an exception because there was Weber was a bigger payment.
Yeah.
Mostly the Weber money into Aussie, and I think there's there's that some other ones there, but mostly it ends up staying there because a lot of the contractors are Aussies.
Yeah, we pay out of the Aussie account for the contractors.
Yeah, that's right. So this might end up being like, say, that subcontractors amount, because I haven't got the right percentages in here.
No,
that's for the right
amounts. Yeah.
You know, let's say that's 80%, and then your other accounts are like, you know.
We don't. Well, actually,
so
we don't.
It's going to end up being very, very little there. But I think it's important, just again, you know, profit first is a behavioural system at its core. And so by actually having that, you know, that cash coming in and then doing the right, you know, allocations out will be important in the short term. And I think what this also does is it starts to highlight, like, you know, sort of, you know, your business in the States. It starts to highlight, well, actually, you know, we're not making any money out of that, and yet it's taking time. So why are we even doing it? Or do we need to look at, you know, the cost structure there? Do we need to look at the pricing there?
Yes.
Because if it's just literally making no money, then why bother even doing it? So by doing this on a weekly basis as well, you're going to start, you know, you're not going to be able to avoid like saying, yeah, no, you know what, I know in my gut the US dollar operations is not really doing anything for me. But once you actually start seeing it in this way, then you'll be like, yeah, no, I'm going to do something about that.
Yeah, it's so I guess I'm just trying to get my head around this here. I mean, what I had gone and set up in Airwallex was you know, another, you know, like a AUD income and a USD income, and then a AUD contractors and a USD out payment. So it's kind of flowing in and then flicking it to the other one, you know, because there'd be no so we kind of respect that income, and then where we apportion it to have the overall COGS percentage between what's in the, you know, what's in the BNZ stuff and then what's in AUD was kind of what I had in mind there, because mostly at the moment as well, like with Airwallex, we don't make any software payments out of that because we don't have the card thing there.
Yeah.
So that's
that's what this is really doing. It's just showing you, okay, so you know, if we take the AUD, for example, let's use a real-time example. So this month, like, about how much will be flowing into that?
I'm just looking at that now. Received, so we've got the transfers. So I mean, that's not a typical payment though, right?
So there would have been, so this month.
Is that's not a typical payment?
No, like the weather was 27,000.
So it's going to be about 20.
No, it'll be 12.5 Aussie.
Oh,
we got the second half of that milk drop, so it's about, it'll be say 16.6.
16,600. Yep. Okay.
Okay. And then how much are
I'd
the
be like
contractors?
it's 100%.
It's everything.
It's
It's 100% of that will be paying people plus some.
Plus
Okay.
Because 1,600 is not enough to pay everybody out of the Aussie account.
Yeah.
So that's kind of where
I think it should just be 100% for the subcontractors. We should just use it as a.
And then the USD is mostly because we don't have any like people. The USD one is pretty much just for well, there is one subcontractor.
The USD one.
Instead of software for clients, or it's like the it's
we do use that for
OIA.
So it's storage and or transactional. It's transactional cost for clients. It's some marketing, right?
No.
OIA is storage.
There's
freight forwarding.
There's freight and storage, and then there's Perpetua,
which is ads, marketing.
Yeah.
And we pay those both in American dollars.
Rather than marketing, because that could be misleading.
Sorry.
I'd literally just put Perpetua.
It's
or ads. Advertising, ad cost.
Ad cost, yeah. And so we have coming in there. It's kind of a transactional account, isn't it? We get a bit of revenue into that account.
It's going to vary each month. You see that this one just
payment of rack studs, but that's for the ads, isn't it?
That's for the ads, So it's like whatever the ads are, it's just straight through.
You're going to get more American clients, do you think?
We could get. Well, we could get Gallagher to pay us into that account.
Where's Biosint?
They're Canadian.
So they don't pay into there?
No.
Where do they pay?
They just pay into BNZ.
Oh, right, okay.
Yeah. We could actually set up a Canadian account.
Because I think what I want to get you guys to is where, because at some point with their wallets, you are going to be able to do the cards and everything. And
so we won't need to though.
Well, they'll be direct.
It's honestly, I think it's overcomplicating it. I really do. At the moment, I think maybe later down the track we could look at it, depending. But at the moment, if there was a way to kind of just think that the Australian account is going to be contributing towards the subcontractor's cost, that the USD account is pretty transactional for those clients that are based in the US, and it's just convenient for us to get their money in to pay for the things that immediately need to go out, because it's not our money, it's their money, that it's just transactional. It's their costs, and it's just going through. It's flow through, and it's going.
I guess that's my that's sort of my point, is that so you're doing all of these things for these clients, and yet you're not. It's no benefit to you.
Oh no, it is
literally just a pass.
It's part of, but it's part of why they're working with Cell Global, is to have these services. These are part of.
So you should be making money off that.
But they make.
You think?
Yeah, well, I mean, it's
not your agreement.
It's like a cost. We bill a bit extra for the admin time.
Not much.
We added 10. We kind of, it's like we make $1,000 a month, but I guess for the cost of doing the invoices,
doesn't pay for
chasing people up on it. We don't make money.
Yeah.
But if we took it away, then
we're not doing what we've contracted to do with them.
No, we're not.
What's your agreement?
Yeah, well, then they're going to have to find else.
You can't just tell.
It's almost like it's a reason. It is a bit of a reason some people are with us for the other stuff, So
completely, and I'm not suggesting you stop doing it. I'm just suggesting that you need to be covering your costs, and then just a little bit.
A bit more
to make it worthwhile for you to do it.
Who are we literally doing it for? In the US, it's grandpa's feeders.
You see, and he pays us we've got a commission there. It's like $8,000 a month we make off him. So
you don't want to be right. So that's the point, Jen. There with grandpa's feeders, who's one of the companies that use this kind of transactional USD business for their ad spend. they have another percentage. Where does that come from?
You mean for the OIA? But no, so we make 8% of their revenue on.
But
on
where do
Amazon.
they pay that into?
They pay that into the BNZ.
Oh, so they pay that into the BNZ. So we then make 8% on their overall revenue of their sales. So doing that transactional work for them is an important part of getting that 8% revenue.
Yeah.
Because else we wouldn't get it.
Yeah, because Mark kind of manages that for him. But I point taken.
Yeah.
In terms of that, you know, we can look at it and just go, okay, how do we either make it way more efficient or
I think way more efficient is an interesting one. And then we've got
yeah. Anyway, so
because I also feel like it's actually a service that would be so beneficial for so many New Zealand companies that that you could actually start expanding that, and therefore there may be, you know, this may become its own little profit centre.
Yeah, correct.
Are we on top of the IA payments?
No,
because
that's the
other. Well, can I say that?
Well, it's just people aren't paying us, so we can't. So we've
kind
of
had to. House feeders have been paying, haven't they?
Yeah.
But is it for other OAA clients?
Well, I mean,
it's legacy debt to OAA.
Yeah. Well, what's happened basically over the last kind of 6 months is because we've been making little losses of $5,000 to $10,000. We've been paying down debt at 13 grand a month, but then it's shifted to accounts payable. So the debt is turning up in accounts payable as we've been. You know, so that this is the point where we go, right, well, we have to be making
take that money.
30,000 a month, and we'll clean that up, and then going forward it's money in, money out. We don't even touch it. Like it's just into that account and out of that account, and and we know it's always there, and so this is just the hump we've got to get over. So I think in terms of these accounts,
I just feel like we have to keep these.
So rather than doing I've just had a thought. So rather than doing this then as a percentage, why don't you just to sort of start having a look at this on a weekly basis? Just go and put in the revenue, put in the actual costs. So don't do the percentages, just put in the actual costs and see what the effect is on your real revenue, and whether that's because then that gives you the more full picture of having all of your real revenue sitting over here.
Yeah.
Okay.
So we've got to just see what.
Yeah. Okay. So I'll make that
adjustment
then. Yeah.
Yeah, because these, I mean, like we look at the, I mean, you go 110. You see, that would be including the GST piece. So it's actually, you know, technically should be, if you've got 130 plus GST on the relevant revenue that's GST, it's going to be more like 140 something.
Yeah.
And isn't it? You know, then so that GST piece straight off the top.
Yeah.
And then you've got that. See, that software one is.
So for that USD, oh, sorry, you're looking at this now.
Yeah, I'm just going to change my view here so I can see my other spreadsheet.
Yeah.
Have we got a copy of this one? Have you seen this one through to us?
No, I wanted to go over it with you first, and then I'll send it through today.
Right. Yeah, cool. So if we look at that software for clients one, like that percentage there needs to reduce because it's more like 8,000. So even if you drop that down to like 6.
Yeah.
Yeah. And then the that there's about right. And then the subcontractors get that down to 55,000. So if you drop that down to like 30, just see where that lands at, and then we might need to bump it up a bit. Okay, no, go 35. There's that. 40, 37, 40.
40%.
40 is about. Yeah, 39. Right.
Okay.
That's out of that. That's oh no, that's total subcontractors. Yes,
Well, yeah, ignore it. Like
just
this
ignore
is
that one
just
for
the
now.
total, right? This is just like the overall.
Oh,
metrics.
okay. So it's not really NZD. Well, it is.
Yeah.
It's
kind of
it's fine.
Ultimately, it's all the picture there.
So what's not working? We've got
okay. So then we go
owners pay.
Well, so owners pay. Even if you see, I mean, for kicks at the moment, if we bump that up to go 18% there, just to see where that lands. Is that 18% of that doesn't make sense. Oh, is that 18% of real revenue? Okay.
Yeah, see, all of these percentages now are off real revenue.
Real revenue. Yeah. Okay, we'll make that 20% just to fit a round number. Okay, and then so tax at the moment, make that 0. Then we've got salaries. So that there is less. So that's go 10% there. Even that's maybe a touch high. Go 9. That's right. And then software for the company. Now this part is a lot lower. That's really going to be even go 2%. Yeah. Maybe go 3%. Yeah, that's on the slightly higher side there. It'll be, but that's about right. Then you see, then debt killer that there needs to be 4 times that. It needs to be 16%.
Yeah.
Or even higher, really. Like that. Well, yeah, it's even higher. Go 20%.
Yeah, because see, we've got 6% to play with there, so we can do 20%. Yeah.
And then right, yeah. Okay, so then we're getting down to
you've got 2%.
Well, marketing is going to have to be 1%. You see, okay, right. So this other operating expenses at 42
way low.
Is high.
Yeah.
So this is where I just need to change my screen to go back and have a look at what
OPEX was.
I'm just going to share this budget with you, Alice, as well. So
yeah, it's okay. You can do that after.
Well, I'll share it now just so you can pull it up on.
Oh, I see. Okay. Which account are you sending it to?
It's in the cell. What is this here? Accounts at or
that's accounts at?
Okay. 1 second here.
Okay.
So you open that up, then we can.
Which screen should I? Okay.
Open live budget. And then scroll down.
Did you just email that?
No, I just Alice got this in there with her own laptop.
Okay, cool.
I just sent that to her just so I could
Oh, right.
If I exit full screen here and I make you smaller, that bigger. I've got quite a big screen, so I can
look at things.
Okay, right. So the
we wanted to find the OPEX.
Okay, yeah. So like literally that I'm kind of going back to row 12 again, row 34, sorry, on you. So software for clients, I've got 843. Yeah, that's fine. Other is that's correct. The freight stuff, just netting that out. The subcontractors actually make that 40%, the subcontractors.
Okay.
40. Then so then we've got you got profit there, you got owners pay, even just bump that to like go 22%. I'm just curious to get up to 15 just to see what that looks like for now.
Okay. Yeah.
Take it down. What is that then? 21 might even be too high. Yeah, there we go.
That's 15,000.
Okay. Then we got so salaries, staff. I'm going to include like commissions here. So that is actually what does that sum to there? 8. Because there's Kiwi Saver and stuff like that. So that needs to end up being, well, it needs to, the amount needs to be $8,000. Yes, or whatever, 8,000. Yes.
Or 11. 12.
Yeah.
There we go.
That's on the high, but yeah, that allows for stuff there. And then other software.
We're at 101%, by the way. So
is correct. That's like 2,000. Because that 42 is too high.
This OPEX is way too high.
Yeah, that's going to come.
Yeah, so we'll deal to that. That's the last one.
If that's the OPEX there, honey, is that OPEX there? Those things?
Yeah. So
that's 4,160 in that month without international travel. So you might want to do the international travel month. I don't know. 6,275.
Okay, yeah, so we get down to, well, the professional development, that goes, put that up to, if we double that, where does that leave it?
How much are you paying him a month? That's,
well, it's actually that might just be 2.5. Go
2.5.
See what that lands. 2.5 or 3, but again, we can play around with that. Go 3, put 3 there. Okay, and then other operating expenses, the dollar amount is.
Oh, maybe that's not right.
No, it is, like, because the difference here is we're dealing with 140, and previously it was 110. Okay. So even if we go right, because I know like March I've got some travel. Like if the dollar amount ends up being 6,000, that's 1/5 of 42. So it's going to be more like even 8%.
Yeah.
Make that 8%, and then where is that? Okay, make it 9 or 10. Make it 10.
Let's do 10. Yeah, just so you're not like completely stressed out if something pops up. Yeah.
And then so then that leaves like debt killer to be like go 40%.
Yeah.
Because that's like accounts payable and stuff like that. And then
so is something not right? Or is it in
so tax? I'm actually going to, now that we've done this, so we've got 9% left over, I'm actually going to start having you put some money aside for taxes, for future taxes.
Yeah.
So let's do 5% in there.
Yeah.
Because, as you said, you're going to have like, this tax bill of around 120,000 next year. So let's start actually planning for that already.
Yeah.
And then, so now now that can go to 44%.
Is something not right?
No, let's just recap that. I mean, so that adds, you see, because you've got the GST there, right? That this here is a reflection of what I have put in here. So the only thing is like you said, this is probably a better reflection for the month of February, you see, because I'm still going to have Salesforce next month. But so that actual software for company
it's going to be a lot more.
That's actually going to be in reality more like $5,000. So that there, what is that currently percentage?
That's 3.
It's probably going to be more 6%.
Like 6%. More 7.
Yeah, it's going to be that.
Yeah. Okay.
So you drop the tax down.
Yeah, or debt killer down to 40.
Debt killer, let's do 40% there.
And then the only other one is like, see, this will mess with all the numbers if I go. Well, just with Christine and just what I do around the group. So I guess with, because obviously we're having this conversation, like one of the things I'm actually considering, Jen, is just what we do with the e-marketplace group.
No, fair enough. Yeah.
So, because like paying Christine, I've managed to cut it back to 16 hours a week. But I've got to have a conversation with her today about basically, we've got, without getting more people in, it doesn't work. And each month. And so it's so kind of putting a bit more onus on her, like to go, hey, look, are you up for the challenge of actually
selling it?
You know,
getting.
But we're going to change some of the price. Well, one option A is to go right. Let's have two. You know, there's a $3,000 option, which is you can be part of the group conversations, the videos, and the chat, and but it's not. You don't get one-on-one. You know, but you get that over 12 months, kind of a bit like that. Anyway, so that's one option. Then you can upgrade people into, you can get one-on-one help for, you know, well, I guess this, you know, it could be then for the like $7,000, you get a call a month, and you know, there'll be some parts that will help you with getting set up, or it could just be a $250 an hour ad hoc if you want a call, you know, like just to kind of lower the barrier to get people in, and so in doing that might help get some momentum. You know, or I mean, one option is to go, look, let's help those people that are in there now, but with the existing contractors, you know, we'll kind of come up with we'll do, you know, I'll do a call, but we'll get Kirsten to come on, talk about design, or Mark to talk about other parts, or, you know, that sort of approach there with what we've already got. So I've got to just make a clear decision on it. Like, and last night doing these numbers was kind of part of getting clear on what we do. So that's the
and what I'd suggest, being a client in the program, I'm finding that just the showing up and having the chit chat, not terribly, you know, it's becoming a less good use of my time. So I would almost suggest like going down to 2 group calls a month. One is an expert in some new area that we haven't talked about, and that could be someone from your team, you know, around the ads or the graphic design, or, you know, those sorts of things, or someone from outside. And then the second one is Christine, just facilitating, like, you know, because there is some information that gets shared among us, but it ends up being just a little bit of chit chat, you know.
No, I agree. That's good feedback. So,
and then that way Christine's cost would go way down, because it's also only twice a month. And so then the onus on her would then be to, like, you know, go get more clients into the program.
No, that's so that's good. Good feedback. So the all right, so coming back to this percentages thing here, that's how it would look, is say for you know, February numbers could look like this, March numbers could look like this. It's just kind of in the short term. We muddle through. I mean, like, in reality, given how many accounts receivables we've got, like, a lot of that, well, I'm hoping a lot of it's going to land in the next today and Monday, Tuesday, but I know, I mean, some of that's going to then end up landing as cash into February, which will, you know, it's just what that number is going to be. Like, so if we were to do this number, like, I think this is a good version to have, but I think we should also do it on like 115,000, for example, just to see what that might look like. And then you see, because then what that does is so GST, that percentage can stay the same. Software for clients, then the percentage of that needs to go up. Okay, so can we like go back to 140, and then can we kind of create another copy the sheet, and then we'll do like 151, so we don't have to
muck with it.
Or just
copy the sheet. Just copy the sheet.
Create a new tab.
Okay.
Create a copy. Yeah, it's all right. On the next one, just down the bottom. You just click it.
Or right click. No, go back to the weekly calculator. Right click that, and then just go copy. Or
right click. Oh, okay. That's it.
There we go.
Yeah.
So that's
so how are you going for time? Like, because I know
time's
how are we going? Yep, I've got like 5 minutes.
Yeah,
Okay.
yeah. So I think
We can do this ourselves though.
Yeah, so I think like that version of you know, the 140 that works. It's just what it looks like at 115 is the messy bit, right? You know, that's where it doesn't work. Basically.
Well, that's where so what I'm going to suggest is you use the 140,000 percentages, and just in the next one, you know, over the next few weeks, you might be borrowing a little bit from your debt killer account to top up some of these other ones. Yeah.
Okay. Yeah, because that's where the bulk of what we're leaving is there.
That's kind of like
So, and there's things like salaries. That's still probably like looking at the 115 there. You know, owners payable. That's, you know, I just pay myself that.
Yes.
Alice is actually close to getting work.
But my money won't be coming till
it won't come till March, but it makes a difference. It'll make a difference in March.
It'll be hopefully about 2,000 a week.
Yeah. So let me just talk you through what I've done over here. So we'll put Alice's take home in here. So then what I want you to do is, so this is your consulting.
Yeah, correct. Yeah.
So
mine will be put 2,000.
I was more thinking, like with this, I think we need to look at our personal ones. Yeah, I think the consulting company there, that's actually, I think for like Alice, if I paid her at a Cell Global, well, I shouldn't say if, paid her at a Cell Global there, but I think when Alice starts working in her income, I think we look at our personal, I can look at the consulting company as that net amount will go into our personal pool that we then go, right, we've got mortgage, we've got insurance, we've got, you know, our kind of OPEX, and then we've got our food and fuel and then our debt smashing. I think that
we'll keep separate.
So that's how I've set this up. So none of this is feeding into the big one. This is all just separate. So but then it's starting to, again, like just think through, okay, well, so I've set you up on this one at your target percentages. So 50% is going into your owner's pay. You are going to set aside money for taxes, and then the rest is going into debt killer because there's no OPEX or anything.
Mine will be
very little.
My number will be tax taken out.
Okay,
we'll do that later.
Should take home. So
we can figure it out later, Jen. That one's not so important.
Yeah.
Right at the minute.
But in terms of just helping you think through, how do we start smashing through some of this personal debt as well as the business debt? I just wanted to have you do that as well. All right.
Okay, because technically my owner's pay, you know, that then feeds into that. You know, we've got my, you know, after tax owner's pay, Alice's after tax pay. Money I get, you know, the net owner's pay out of the consulting one, and then that pot there of 20 grand a month. Like, what do we do with that?
Exactly.
To you know, start getting getting ahead.
I have a question just about you know, around profit first, as you know, as you say, a behavioural system. How and these percentages that are all worked out for things, they do change for every business, just depending on the nature of the business. They're not like a recommended formula that works like right across all businesses.
So depending on the revenue size, we do have recommendations on sort of the main buckets. So the profit, the owners pay, the taxes, and then the operating expenses. So so what we're trying to do is get towards, you know, basically get to the point where you're at those target percentages. And where it gets customized, of course, is for the New Zealand tax environment, but then also for your business. And so this is why all of these
and
accounts.
the debt level.
The debt level.
Yeah, exactly.
So,
exactly.
So we are out of kilter overall where?
Just
on what are the numbers that we've got that would not be kind of consistent across with other companies? Like where are we trying to head to, like up or down in terms of?
You're trying to head up profit, up owners pay, and up tax.
Okay.
And so where does that come from? It comes from all of the other things.
Yeah,
and because we're
so it's salaries. Are salaries about right for our business, or are they too high?
You know, because you've got so many contractors, I would almost say that they're a little on the low side, but then you've got to factor in the contractors as well, right? To get the whole people cost. So
I mean, mostly like, you know, I think
it's the debt.
We get that 130 a month at a minimum, then it works, you know, and then we improve that revenue, and I just look at this year as like the money is staying, like the profit is going towards paying tax and clearing all the debt. Like at the end of the year, we have no debt in the business. We have 150 grand in the bank, and you know, I haven't taken any more than my salary. You know, I might be able to bump the salary up a bit, you know, down, you know, through the year, but mostly it's about getting the business debt free and cash in bank. And
that's right. And then once that's happened, so what I'd like to get you to is 35% in owners pay and 10% in profit. So look at that, you know, and that's on the 115 there. Now you're looking at like close to 30,000, you know, for you guys. And that's what it's all about. It's like, that's why you started this business, to provide for your family.
That's just on that percentage here, but you get it up. I mean, like, so my goal in the next 12 months is to have a 3 mil revenue, making 600k profit and paying myself 250.
Nice.
Yeah, so because we'll do 1.45 mil this year, so effectively it's doubling it, and that's you know, that's the goal, and then then the business is worth quite a bit at that point.
And I think that's achievable. You know.
Yeah.
All right.
Just,
cool.
Okay. All right. You better scoot. Thank you.
Yeah. So I'm going to send this through to you right now, and then if you send me your budget as well, that'll be awesome. And next week, what I want to go through is actually starting to do some time tracking, so that you can really sort of get a very, very clear picture on where the time's all going. And so that'll be really interesting. Okay.
Cool.
Good. All right. Nice seeing you. Bye.
Thank you. Cheers. Bye.
Bye.
Bye.